Since September 2022, the Federal Reserve has quietly gone bankrupt. Simply put, its balance sheet is in shambles. It writes massive IOUs annually, not only to the US Treasury, but while it's writing IOUs to the Treasury, the Federal Reserve is paying out billions to United States banks, more to the bigger banks, okay, disproportionately. And as is often the case in situations where government agencies, or in this case, a pseudo-government agency, a semi-government agency, when they fall short, you, I, us, the taxpayers are the ones that take the brunt of these crises. We pay the bill on behalf of them. One of the funnest things that we're starting here is a book club, a book giveaway on these webinar series. So our goal with the webinar series is that we're doing 1 to 2 webinars a month. We're building a community around really detailed, in-depth topics that are happening and that we're thinking through at a high level with our amazing investment community. So early on in Saint, even from the beginning, we were working with very, very high-level minds, high-level investors, family offices, etc. We want to grow that community of high-level people. So a book club just kind of seems in line with that. So people that are engaging a lot, people that are jumping in, we have a gift for you today, a free gift for you today, and that's a book. This week's book is going to be called The Creature from Jekyll Island. Okay, kind of a wonky title. It almost sounds like an old monster mystery or something from the 50s, but it's weirder than that even, actually. The Creature from Jekyll Island is the book that outlines the setup of the Federal Reserve. So what happened to get the Federal Reserve set up in 1913, which was the start of the Federal Reserve, what led up to that, the billionaires involved, the strategies that they used, the reasons behind it. It involves everything from wearing costumes to hide their identities, to taking fake train trips to hide their end destination, to ending up on an island with a bunch of billionaires called Jekyll Island, where they hashed out in secret the setup of the Federal Reserve. This is 100% nonfiction, and we're going to give that away today. So make sure to jump in the chat, make sure to comment, make sure to ask questions along the way, and we're going to get you a free copy of The Creature from Jekyll Island, which is an amazing book. And again, the Federal Reserve is not arguably actually, the most powerful financial institution in the world, and it's not even close. So it's probably smart, with a lot of great investors that I'm already seeing still pile in, a lot of great people attending today. It's important that we understand the roots of this financial institution that's the backbone of the greatest economy in the world. So, little gift from us today. Let's see. Okay, a little housekeeping before we jump in and really get into the presentation here. I'm extremely excited to announce that our next webinar is going to be very timely. It's going to be on November 19th. It's going to be a deep dive into the tax ramifications and the economic ramifications of our next president of the United States. So today we're diving in on the Federal Reserve, the most powerful, most influential financial institution, not only in our country, but the world. And we're about to learn in the next little bit here, the next few weeks, hopefully, right? We're about to learn who the next president of the US is. This is big. It's a very interesting, complicated election. Many polls are neck and neck with the candidates right now. Either way, there are big implications for who's going to be in office next. We're going to go through the tax ramifications. We're going to go through the economic ramifications. We're going to go through how it impacts you as an investor and your portfolio. So don't miss that on November 19th, which is just right after the election. And we'll give you the details of the winners, game plan on the economics and tax strategies. All right. Before we jump in, last thing, this webinar, like all webinars that we put on, is sponsored by Saint Investment Group. We are most known for our income fund that pays between 12 and 14.28% return on the upper high end of the fund. We're super proud of it. We have a couple opportunities for you guys to ask questions on that. Also, Andrew, Luke, can you drop a link to the calendar to book a call? Guys, the attendees out there, at any point in time, whether it's right now or whether it's later on, if you want to book a call and get more information, we have complimentary free strategy calls where you get some time with one of our pros, Luke, and he's going to drill down on what we do, what you do, if it fits in your portfolio, and the best way to utilize what the products we have on the market today for investing are. So as always, I'm your host, Nick D'Angelo. Let's jump into it a little bit. First things first, let's set the table. Since September 2022, the Federal Reserve has quietly gone bankrupt. Simply put, its balance sheet is in shambles. It writes massive IOUs annually, not only to the US Treasury, but while it's writing IOUs to the Treasury, the Federal Reserve is paying out billions to United States banks, more to the bigger banks, okay, disproportionately. And as is often the case in situations where government agencies, or in this case, a pseudo-government agency, a semi-government agency, when they fall short, you, I, us, the taxpayers are the ones that take the brunt of these crises. We pay the bill on behalf of them. So let's go through a little overview of what we're going to jump into today. The current state of the Federal Reserve. So in order to understand where we are today, we need a little bit of background about where we came from and what got us here to this situation today. And then we're really going to drill down on the nuts and bolts of how it affects us, the taxpayers, how it affects you as investors. We'll talk about some market opportunities. So how you can go on offense during this time, how you can take advantage of this situation and put your money in the best opportunities that have the highest upside in the future. We're going to talk about inflation because that's the backdrop of a lot of this. We had 11 rate hikes in 16 months. For those of you keeping score, that is the highest, steepest increase that we've ever had in rates in US history. Now, the late 70s, early 80s might take the cake for the highest rates we've ever seen. It was like 20%, right? But the steepest rate hikes in history just recently happened. Now we're just starting to see those rate cuts, the first being 50 basis points or 0.5%. We're going to dive into all of that. Next is protecting your portfolio. So market opportunities, how you can go on offense. Protecting your portfolio is an analysis of defense. How you can look at your portfolio, make some changes, make sure that everything's where it should be. And we're going to wrap up. We're going to go over what the smartest investors that we know are leaning into, what they're doing to protect and invest and grow their wealth in this economic environment, even with the backdrop of the Fed having issues. I love including this. We brag about our investors all the time because we get to talk with such high-level smart people. We also get to see what high-level smart people are doing with their money. Huge advantage and a huge benefit to being at Saint. And we'll give you guys case studies. Market opportunities will be some strategies that we see. Protecting your portfolio will be some things that we see in the market also. But the case studies at the end will be really, really powerful. But first, in case we haven't met, I've met many people. I've met many attendees today. I'm really happy to say that. Yeah, I've gotten to talk to a lot of you. But in case we haven't met, my name's Nick D'Angelo. I am president and founder at Saint Investment Group. I get the opportunity to give a lot of thought leadership, get to appear on a lot of podcasts and stages, etc. I think this year we're going to round out about 150,000 views. Quick math, that we were doing earlier, kind of recently. So very exciting stuff. What we focus on, what I focus on, what my passion is what I like to call economic strategy, being an economic strategist. So sure, many people are investors, but I think many people miss the details of the economics behind it. So we always try to lean into that. We always try to have a very clear economic thesis on what we're investing in and why. And because of that, I'm proud to brag. Some of this is going to be bragging, just the slide, right? We have over 500 mortgages in over 21 states and growing. We see that as a huge opportunity. We're heavily leaning into that. Overall in the portfolio, over 206 million in assets under management. Again, we're very proud of those pieces and the growth that we've been able to do. And again, our fixed income fund, pays between 12 and 14% on the high end. We've been on time with every single distribution for over a decade, and your money is safe with Saint. Again, I love bragging about everything in this slide. Okay, last brag slide, but a few things that we've been able to achieve with our investors that we're really proud of. Over 35% returns, over 7 successful exits. So a nice little track record there. Over 13 million distributed to our investors, 206 million under management, over 10 years in distros, all amazing. We have an amazing team at Saint that is super high level performance. Okay. But don't take our word for it. Really, the best place to get all the information is either check out our website. We have amazing reviews on there where it's word for word what investors and people involved with Saint have said about us. There's a ton on there. Here's 3 examples, some CEOs, some really powerful, great people with really successful businesses. Or Google us. There's a lot of reviews out there. Check us out. Make sure you do our diligence on us and that you are comfortable with what we're going through and who we are, because we're very proud of what we're doing in the market today. Yep. So a little bit about our returns. We touch base on those though. Okay. Quick outline here of what we're about to jump into. We're going to go through a little legal disclaimer, make sure you are disclaimed, and make sure our legal team is happy. And then we are going into the presentation. We're jumping in, whole bunch of slides, whole bunch of amazing details and strategies. Very, very dense, very, very amazing. We'll wrap up with some housekeeping, a couple last minute items to kind of jump into, get you guys some good information on, and then we'll end with Q&A, which is extremely powerful. I highly encourage you to stick around and ask questions that relate specifically to you, to your questions, to your situation. And there's great conversations that come out of that. The best way to go through questions is going to be just straight drop it in the chat, the webinar chat off to the side. You can click a box. It's going to be a text box if that chat's not already up. So drop your questions in there. We'll answer them at the end. Sometimes the Saint team might jump in and give you quick answers if it's things about the investment opportunity or things that they can provide quickly. Otherwise, for the great questions on the economy or investing or strategies, etc., we're going to jump in at the end. All right, let's make the legal team happy. Lots of stuff on this slide. The big takeaways are this. This is not investment advice. These are our findings. This is our research. This is what we dive into, but it's not formal investment advice. We want to be clear. This is for educational purposes only. Most importantly, originally, it's for our educational purposes. So if we're doing all this work, we'd love to share it with you guys. And that's what this is. A look behind the scenes of how we analyze pieces of the market and what's going on. Last but not least, all investments carry risk. So anything we talk about today, assume carries a high level of risk. We went through a lot of the bragging slides, but past performance does not ensure future results. Definitely have to make that point. Although I love our past performance. Our team's great. They've been doing great. Oh, I'm so happy this slide's in here. Okay. I talked earlier about the creature from Jekyll Island. We were sourcing a digital copy of it, and it looks like we found it, and we're giving it away for free right now. So I'll take a second. You can pull your phone out, or you can take a screenshot of this, and you can pull up with this QR code. And you're even ahead of that. She just dropped a link in the chat directly to the book also. This book's for free. So this is us giving you the book for free right now. I cannot encourage you guys enough to take a look at this information of the background story of how the Federal Reserve was created. So I'm going to move past this slide, but the link is in the chat. So you can click on that and you can get a copy of that book for free. So let's start jumping in. Today's Federal Reserve is a vast and complex system. Let's zoom out first. Vast and complex system with both very well-known pieces and pieces that are much less well-known. There's pieces that are very publicized, right? We're sitting on every word, waiting for Jerome Powell to tell us what he's doing with the rates, right? But then there's huge amounts of things that happen behind the scenes that we just don't hear about, or the complexity is not there, or it only comes out, quarterly. We really get a deep look, et cetera, et cetera. But the important thing to know here is, aside from the Board of Governors or the Federal Open Market Committee, which are the most publicized, the most important thing to know is the following. The Federal Reserve has a suite of tools that it can employ and can use at their discretion. Remember, we are dealing with a semi or pseudo government agency. There is political input. The president, Congress has a lot of input on electing officials in the Federal Reserve, but it is not a government agency formally. So it's overlapping, but it's not. The Federal Reserve does. The Fed has a mandate. The Fed mandate has two goals. Everything that we talk about today and every single decision that the Fed makes is based on 2 points. So we're going to drill down into these. The first is to maximize employment. Okay. The second is to stabilize prices and currency. That's it. That's everything. That is literally what they're focused on. Okay. That's called the Federal Reserve's dual mandate. So maximize employment. Let's quantify that a little bit. What exactly does that mean? That means they want to minimize unemployment. So unemployment, they try to keep right around that range of that 4 to 5% to quantify that a little bit. Getting above that makes everybody real uneasy. Nobody's happy with that, especially the Federal Reserve. That's their first mandate. The second mandate of the Federal Reserve is a little more publicized. This is stabilize prices, stabilize the financial markets. How do they do this? As we all know, it's managing the interest rates. So the decisions that the Federal Reserve makes on the second of their dual mandate is what is most publicized and talked about. As we said, the tools of the Federal Reserve, there's a whole bag of tricks that they got, but the top two include interest rate hikes and cuts. And the second is quantitative easing and quantitative tightening. So interest rate hikes and cuts, that gets enough publicity. We don't have to over dive into that, although we will talk about the impacts later. But quantitative easing, what is that? We'll just do a brief overview. That's when the Federal Reserve buys assets, okay? They buy assets for their balance sheet. So that's quantitative easing. They're injecting money into the market and they're taking assets out of the market. Federal Reserve, quantitative tightening is when the Federal Reserve sells assets, meaning they take money out of the market, okay? So interest rate hikes and cuts and quantitative easing and tightening are the number one and number two tools of the Federal Reserve. Interest rates. Let's dive in a little bit. So while this is among the most visible of the responsibilities of the Federal Reserve, the Fed does not directly determine the rates that we as consumers experience. So as you go about your life, attendees, and I see some new people jumping, oh my gosh, John G. It's been a while, my friend. I hope you're doing great. Hope the travels are going great. Great to see you here today. Jason, great to see you. Everybody else, thanks for joining. Great to see you guys. Okay. Where were we? So the Fed does not directly set the consumer rates that we experience as consumers. So if you go buy a house, the rate that you experience from Chase Bank or Wells Fargo, they're not directly setting that specific rate, okay? What the Fed can affect and what they can set is the federal funds rate, which is also often called the overnight rate or the Fed rate. The Fed rate is the amount that banks charge each other to borrow or loan money to each other overnight. So one bank might be cash flush, lots of cash on the books. Another bank might need the money to, pay some bills or to pay out some loans or have some obligations that they need to cover. So that rate that they trade money back and forth is the interest rate that the Federal Reserve sets. That's one of the things that they can do. For us as consumers, the federal funds rate is often around 1% to 2% less than what we experience on the single family home mortgage market. So let's take a very pertinent example to today. If the Fed funds rate today is about 5%, which it is after the 0.5% rate cut, then mortgage rates in the market when you buy a single family home, typically between 6 and 7%, kind of what we're seeing today. So this holds true right now, exactly with what we're seeing in the market today. The Fed discount rate. So another confusing reference that you're going to see that's often not well explained is the Fed discount rate, which is the rate that the Fed charges banks when it loans them money. So when a bank goes to the Federal Reserve, that's the Fed discount rate. This rate is typically higher than the federal funds rate for one powerful reason, because the Federal Reserve prefers and wants banks to be lending to each other and doing business with each other before they start coming to the Federal Reserve and begging for cash. Okay? They want to incentivize the interbank transfers, the interbank working together before people just go to the Federal Reserve and hit them up for cash. That makes a lot of sense. That doesn't always hold true in the market. One big example of that is COVID-19. So in the face of a global pandemic, something we hadn't seen for, over 100 years, right? We saw that those two rates, the federal funds rate and the Fed discount rate, got very close to each other. Basically, it was the Federal Reserve saying, hey, we're throwing out all the rules. We're trying to make sure that banks are well capitalized. It's pretty smart, actually. They also did all kinds of other things like extended the allowable borrowing periods to 90 days, et cetera, et cetera. They loosened up a lot to make sure that they provided support for the COVID-19 era. So when the Fed raises or lowers rates, financial institutions generally mirror that change, right? So that's what we experience as the consumers. So in this case, if the Fed increases the Fed rate by 1% or 100 basis points, same thing, 1% equals 100 basis points, then the bank that you borrowed money from, using a credit card or another loan, et cetera, is likely to raise the rate, oftentimes 1%. In lockstep. It might be more or less, but more or less you see that impact, in parallel, right? When rates, here's an important point. Here's an important point of why rate hikes or rate cuts work. Okay, these are the action points of how the money system works in this regard. When rates are higher, it creates a situation where people want to borrow less. It disincentivizes borrowing money. It's more expensive to do so. And at the same time, oftentimes savings rates at your bank will go up. So it's more expensive to borrow and put money back into the market at whatever speculative stuff you're doing. And it's more incentivized to keep the money at home. So it slows by two different ways. It slows the money down considerably. That's why you typically see this when high inflation hits in the US market. It's exactly the playbook that the Fed jumped into as soon as we saw the spikes. This slows the economy down dramatically, obviously, at least in most cases, right? There's times where that's not always the case. When inflation increases beyond the Fed's goals of around 2% dramatically, they pull out other stops as well. So the reverse is also true, okay? The reverse meaning the other of the Fed mandates. So when unemployment raises beyond the 4 or 5% and the Fed wants to stimulate the economy, they want to get money back in the system where people are buying and selling and consuming, right? Again, we're a consumer-driven economy. Other parts of the world, China is a manufacturing-driven economy, right? So it's a different model. These levers that the Federal Reserve pulls are very, very fine-tuned for a consumer-driven economy. So when unemployment rises beyond 4 or 5%, and they're uncomfortable with that, many employment question marks are in the economy today, the Fed starts to want to stimulate the economy or lower rates, meaning the savings account returns or the CDs that you're getting at your bank start ticking down and the rates start ticking down. So then you want to get more money and put that back into the market and stimulate that consumer economy. So that means that businesses are likely to hire more, get people back on payroll, to tighten up that unemployment. that to reduce that figure so that that Fed mandate, that maximizing employment mandate, they can check off their list confidently. So what happens to the two biggest classes, the loose classes of loans, fixed rate versus adjustable rates? The most immediate impacts are obviously going to be on adjustable loans. So think of credit cards. That's the most quickly hit are the credit card rates. Most Americans today have fixed rate mortgages. Thank God that we learned our lesson in the wake of 2008, which a major driver of that was these ARM loans, these adjustable rate mortgages, where when interest rates went up, people couldn't pay their mortgages, and what was meant to slow down the economy ended up crushing the economy by having the biggest foreclosure crisis we had ever seen, right? So most people are smart enough today, there's sophisticated people that still do adjustable rates, especially on the commercial side, but most people don't want to deal with something like that. The amount of unknown when it comes to where you lay your head at night or your family and where everyone's going to sleep and live and make memories, nobody wants to deal with that. Percentage basis, very, very minute, small percentage of people that are in adjustable loans for their homes. Other things, auto loans, you can even see as adjustable. Credit cards are the obvious one. Personal credit lines, all of those are typically going to have a majority adjustable rates to them. They're hit first in situations like this. So what are the impacts of these rate changes? Okay, we kind of went through the basics. Borrowing's more expensive if rates increase, and the reverse is also true. It's to stimulate money in the economy. It's demand and supply at its core. So for most people, the actions taken by the Federal Reserve have a genuine impact on their exact personal financial condition. So you see a list here. This is just a general outline. There are a million more, but think about how this impacts us on a regular basis as an economy. Consumer confidence, right? In a consumer-driven economy, that alone is something massive to manage by the Federal Reserve, by politicians, et cetera, sometimes to the point where they're not completely honest with us. We'll go into that. We'll talk about Miss Yellen and some of the statements she made in the past that seem a little more politically driven or strategically driven than they were driven on actually what's going on in the market. All right, so we're going to dive in here and we're going to start. Hold on, let me adjust one piece here on this slide. Okay, there we go. So fast forward to today. What are we seeing? This is a nice look at the overview of many different rate cut cycles that we've seen historically. These are big. I mean, most people that are looking at this can sort through what some of the bigger ones are, but what we're looking for here is what happens to the market. What was the impact after large rate cuts? The 0.5% rate cut that we're talking about that just happened recently is out of the norm. Usually we see 0.25% when they start cutting rates. So let's go through some examples of when they did the 0.5% rate cut. 2001. Large rate cuts following the dot-com bubble and the 9/11 attacks. They did the same rate cut just recently. Okay, pretty dramatic. 2007, 2008, 0.5% rate cuts followed the housing crash and global financial crisis. As a matter of fact, that degree of rate cut went all the way down to 0% for the federal funds rate. Okay. Remember how we talked about earlier, the federal funds rate, they want to lower it so that it lowers the rates for the consumers, et cetera. It didn't work. They brought it all the way to 0. Remember when mortgages were in the 2s, right? I don't know if we'll see that again in our lifetime, but that still didn't work. We still needed record quantitative easing. We still needed big fundamental changes in the marketplace that we're going to go into in a moment that changed how the entire thing works. The 2007, 2008 era is the Bernanke era. And he did things that were unprecedented. And I mean, again, he won the Nobel Peace Prize. So the guy's not a dummy, very intelligent, but also very aggressive. So I'm excited to jump into those. We also saw some rate cuts in 2019. You know, the COVID-19 pandemic started, 2020, etc. Then we saw the steepest rate cuts in history in 2022 through 2023. Just a reminder, inflation peaked mid-2022 at 9.1%, and we stayed at that very high level, not inflation, high level of rates, until the September 2024 rate cut recently. So what do these rate cuts mean for us? Here we are now. We had all these cuts. We went through the history of cuts a little bit. What does that mean quantitatively? How much do we actually expect the market to be impacted on a percentage basis? Ooh, I love this data. Ooh, soak in this chart. Take a look. This is a really good breakdown of from the first rate cut to how much drop in different areas. What this shows, and what we're looking at now, is what happened to the 10-year rate after the Fed started cutting rates. The average decline in the 10-year after the first Fed rate cut is 37%. Can you guys see my mouse? Oh, here we go. Can you see my mouse? Can you see my cursor?
Yeah, we can see it.
Okay, amazing. So there's that 37. That number is brutal. So a 37% drop. Think about your CDs at your bank today. Let's take a good old fashioned 4.5%, something that's semi-common today. You know, you might beat it, you might not. If you reduce your 4.5% CD in your bank today, you're looking at about 3% on that same CD. The most recent inflation, the most recent CPI was at 2.4%. So you're looking at 0.5% return based on the CPI numbers if you're going on historical averages. That is interesting. The question is, are you comfortable with making 0.5% return on your money going through CDs at your bank? Only you can answer that question, but at least you have the data here to make that to make that question of what might be coming up ahead. So let's start diving in and beating up on the Fed a little bit and really looking at the numbers and charts behind what's going on today. Since September 2022, the Fed has quietly gone bankrupt. The balance sheet of the Federal Reserve is in shambles, like we said. The reason for that is simply put that IOUs are being written to the Treasury Department, whereas the Federal Reserve used to pay out billions to the Treasury Department. Again, the Federal Reserve is supposed to be a nonprofit agency. The goal of the Fed is not to make money, okay? So the excess returns that the Fed made historically and by law are supposed to go to the Treasury Department to cover their bills. That's not what's been happening. Instead, those dollars have been going to the largest banks in the US disproportionately. Again, just to harp on this and bring this home, the difference of what the Fed is writing IOUs to the Treasury Department, we are paying for as taxpayers. There are impacts to that. So let's back up and understand how we got here. The 2008 financial crisis set in motion what is called by many a death spiral. A dramatic term, but we'll see why such a dramatic term is being used. This, look, the 2008 crisis was by far the greatest financial crisis in history. We didn't know a lot of different things about when that would blow up, but there were some early warning signs of 2008, just like now there are some early warning signs of the decision that the Federal Reserve is making and some early warning signs of what that could go to. Before we overly dive in to exactly what's going on the charts, we need a quick primer. We need to kind of understand the basics of the Federal Reserve complex system that we're looking at, just so we have the basics of the system so we understand what's necessary. So we talked about the Federal Reserve was created in 1913. It's the central bank of the US. So arguably one of the most influential economic institutions in the world. I'm going to say not arguably. I'm going to say definitively the most powerful financial institution in the world. This is just an example of how money flows, because we're going to get into the details of what each stage of this looks like. Okay. Federal Reserve to the Treasury, Treasury issuing their bonds, bonds to the banks, how that flows back to the Federal Reserve and they buy some of those T-bills, those T-bonds, how those go to consumers, how the money goes back to the Treasury Department. This is just a nice, simulated, simplified overview before we get into the weeds here. All right, let's talk about something that is not widely discussed because it's a little bit more complicated than what you can put into a 30-minute news segment, right? There are three types of money in the economy today. The first is commercial bank money. This is created by commercial banks. This is created by banks, usually by making loans. So if a bank gives a $100,000 loan to a consumer and that rate is 10%, they created $10,000. Okay, that's the concept here, because there's $100,000 given and there's $10,000 owed as 10% interest. So that's called commercial bank money. So it's not quite inventing money from nothing, but now an extra 10% exists in the financial system. So that's attributed to commercial bank money. The next two are what the Federal Reserve directly impacts on their end. Federal Reserve notes, that's the next. That's what we talk about when we're talking money. When you're talking $100 bills, if you look at the top of 100, that is a Federal Reserve note. That is backed by the full faith and confidence of the Federal Reserve. And that's what we're talking. That's what most people think of money. In reality, that's a small percentage of the financial system. So I'm seeing some big names on our attendee list. Yeah, a lot of y'all will know this. We actually have some bank CEOs that we've invested with and have invested with us. So we have a lot of really good discussions back and forth and a lot of good insight on this. So anyways, bank reserves, the third type of money that exists in our economy, bank reserves in the checking accounts of the Federal Reserve member branches. Okay. These reserves never go into circulation. These are held. So it's a separate monetary system if you want to think of it that way, because it's only used by the Fed and its member banks. So yeah, I don't want to over drill down because we'll jump into this in the next couple slides, but these reserves are critical, and these reserves have changed our entire financial system with how they're treated and how they started being treated by Ben Bernanke. After the Fed pays its expenses, I got to harp on this. After the Fed pays its expenses, it is to remit profits to the Treasury Department. The Fed does not create money. The money printer go burr was the funniest meme by far in the financial sector in 2020. It was, pictures of pictures of Jerome Powell and a money printer in the background. And the idea was that anytime there's a problem, the Federal Reserve just flipped a switch and all that money was printed and all the problems went away. Okay. We then saw that inflation took off more than we had seen in decades, but that's a different problem, right? The reality is the Fed does not actually print money. It can create money through the three types of currency that we just talked about, but profits, it is to remit those payments to the Treasury. The Treasury is what prints the actual dollars. Okay, we talked about two big levers that the Fed can pull. Let's talk about quantitative easing and quantitative tightening. So as we said, the Federal Reserve Act of 1913 created the Federal Reserve, but it also laid out the foundation and the playbook by which the Fed operates. The Fed is restricted to buying assets. It can buy assets, but it has to only buy assets that the principal and interest are guaranteed by the US government. So in that way, it's a self-sustaining system, right? It's kind of enclosed. The Fed can enter the marketplace, but those have to be US government-backed assets. So what am I talking about? What does that even mean? Treasury bills, treasury bonds, and mortgage-backed securities. In this way, you could say that the Fed prints money because they credit the books of the primary dealer banks, right? Once the Fed wants to get those assets, the treasury bonds, mortgage-backed securities, all they do is credit that bank that they bought those from, right? It's not real money in the sense that it was in one account and went to another. It just appeared in the primary dealer's bank account. So in that way, they can print money in that, but they don't print the physical money. So 2008, we already talked about how 0% interest rates did not work. What a scary predicament for a Ben Bernanke and a Federal Reserve Board. The Federal Open Market Committee. I wonder what their discussion was, saying, hey, you know how we lower rates when things are bad? Yeah, we're at 0. How do we lower more? Because if they lower rates below 0, like, let's say Japan, right? If they lower rates below 0, that actually incentivizes people to take their money out. That means at that point, for saving money in the bank account, you are getting charged interest. Most Americans ain't having that, okay? So 0 is as low as we can go for our consumer-driven economy. The Federal Reserve agrees with that. So in 2008, the Federal Reserve started their quantitative easing program, and they were making big purchases, right? We talked about bonds. We talked about mortgage-backed securities. A huge portion of this was that they had to create currency in this way by Federal Reserve IOUs to the member banks. So they appeared that money into the accounts. What exactly, let's just pause for a second. What exactly is a primary dealer? Well, let's just name some of them because we're all going to be on the same page. Goldman Sachs, JP Morgan, et cetera, et cetera. It's the biggest of the big names in finance. So they had that money appear in the account of those big dealers, the Goldman Sachs's, the JP Morgans. So what's interesting about this scenario is that for every dollar the Fed writes an IOU for, there are $2 created in the financial system. $1 goes to the bank reserves of that federal bank account. Another goes to the IOU. It credits the primary dealer bank account. So in that way, one purchase creates $2 in that, $1 of purchase creates $2 in the system. This stimulates the financial markets pretty aggressively. So that's why quantitative easing and in reverse quantitative tightening are so powerful, but it does have a big impact on the market. It makes a big splash. It also makes big problems if you're not careful and you're the Federal Reserve. So I'll let you guys read this and then I'll give the context. There was a big change in 2008. Ben Bernanke, in all of his wisdom as a Nobel Peace Prize winner, he did something called throwing many things at the wall and seeing what sticks. Okay, that's not the technical term, but that's kind of the more descriptive term. In 2008, when things were hitting the fans, he did many things to test that were many things that were untested because the 0% interest rate was not working. One of the things that he did to prop up banks, particularly, I'm going to say this 3 different ways because it's so important, and this is the crux of so many things. Ben Bernanke in 2008 started paying interest to Fed member banks on their reserves. Okay? Reserves are it's another lever that the Federal Reserve can pull for banks. If they increase reserve requirements, that means less money in circulation, and it also makes the banks more stabilized. In 2008, we were having discussions where we didn't know if the big 5 banks were even going to make it. Y'all remember that? That was scary times. That was financial collapse discussions. So Ben Bernanke made some mistakes, but he also, you got to understand, he was looking at a potential financial collapse. And if the US financial system collapses, that's the world, right? We are the backbone of the world, reserve currency, et cetera, et cetera, et cetera. So he pulled out all the stops. So again, to over repeat this, Ben Bernanke started paying interest to Federal Reserve member banks on their reserves in the system. This was the first time in history this was done. So why specifically did he choose this route? Because by paying the member banks interest on their reserves, it built up the reserves further. It incentivized them and boosted them at the same time. They had more money on hand and the reserves got bigger. So in a way, it really fully aggressively supported them Yay, that's really good. And they needed it at that period of time. Anyone who remembers that will absolutely agree on that piece. So this interest injected into circulation and into the economy things through the banks, which let the banks benefit from that. However, here's the trade-off, which at the time wasn't as big of a deal, but over time became a bigger deal. Now that the Fed was paying out interest on those reserves, the Fed also had less profit to send to the Treasury to pay down the general fund. We talked about that earlier. This is us circling back to that point to highlight it. Again, the Federal Reserve is not to keep the profits. They must return those to the Treasury to pay down the owings of the general fund. That was happening less and less as those profits were going to the reserves of the banks and paying interest on those. Here's some quick math on what that kind of looks like. Bank reserves times the interest rate that they pay. And to be fair, it's a small interest rate. I think offhand it's 0.2%. But with such overwhelming dollar figures that go through banks like JP Morgan, it's a huge number. It's a huge, staggering number. So what's the effective net impact of this? The higher bank reserves got and the higher the interest rate got, the more the Fed pays out in interest. Simply put, this is why the interest rate increases in 2022 have been so deadly for this structure that Ben Bernanke started in 2008. In 2022, the Fed interest rate hikes caused payments to banks to catapult from 150 billion to 483 billion. This is the death spiral that we brought up earlier. Okay. There is no mathematical easy way out of this situation. Okay. Remember, as a reminder, prior to 2008, zero was paid out in interest. And the 483 billion that we're talking, that's just this year alone, we're covering as taxpayers, while the banks are taking that in-house in interest payments from the Fed Reserve to the banks. So let's dig in. As promised, we want to see the charts behind this so you can hear what I say. You can hear the numbers I'm throwing around. Let's look at them in relation to each other. Okay. The first set of charts will cover up to Q1 of 2022, which is just before the interest rate increases started. Okay. So we have kind of the pre-2022, post-2022 layout of what these charts look like. In chart one, we see how bank reserves soared in late 2008, right? Let's see. Yeah, you can start seeing those really start peaking. So it was really low here. Starts to climb, starts to climb, starts to climb. As you look at these charts, you can see more and more different era of what those bank reserves looked like. Okay, this tells the history of the last, couple decades of finance in the US, just based on bank reserves. That's a pretty good chart. Chart 2 shows the interest rate paid on the bank reserves. Here you go, right? Chart 3 shows the steep increase in interest rates paid to these banks by the Fed. Again, this is bank reserves. This calculation is bank reserves times the interest rate on those reserves. This is a staggering increase right here, okay? And then we see the payments increased by the Fed. Shows the payments increased by the Fed. Yeah, right here. So we see what these increases are pre-2022, 2024. This is the scary part. Okay, I'm going to remove my cursor. So, oh no, the cursor's already there. So you can see where we're going with this. Okay, chart 1, bank reserves very high. Good. Right? We needed that for a long period of time. We needed to insulate banks from the craziness of the economy. Chart 2 showing the interest rate percentage paid on bank reserves. That's a little scary seeing that jump up. Chart 3, the steep increase that we're seeing in interest paid to the banks. And chart 4 is a scary one. This is the shortfall in the general fund. Okay. This is where the wheels come off. This is where us as taxpayers are paying the difference for this policy. Now, the Fed experienced a $114 billion loss in 2023, which until this point, I mean, the Fed would, it was in the green 58 billion in 2022, right? So a lot of that was, this loss, a lot of that loss was caused by the increase in the interest expenses and what their payouts are to the member banks. According to 2023 annual financial statements, the Fed has just 51 billion in equity total. And I hate this number, but it's the reality. A whopping 948 billion in mark-to-market losses. So anytime you see a loss, that's us as taxpayers filling that in. Okay. So I'm going to be honest. We didn't tell the truth that the Fed is bankrupt. The Fed isn't bankrupt once. The Fed is insolvent 19 times over. That's the reality. So they're not 1x bankrupt. They're 19x bankrupt. I don't even know how to put that in a title, but that's the extreme situation that we're dealing with here. So the biggest shocker is, why aren't we seeing this all over every Financial Times? Why aren't we seeing this talked about on Squawk Box in the morning? Why aren't we seeing this in The Economist being overly covered to get this back on track? Because it has massive impact on the market and us as consumers, us as taxpayers. So without question, this is a massive and scary problem. The Fed has to pay the financial obligations and liabilities and all the things that they have. Depositors, right? That's us. Commercial banks, JP Morgan and Bank of America, have over $3.5 trillion of their customers' money, which is AKA your money, with the Federal Reserve. The Treasury Department has over 700 billion of deposits at the Fed. Okay, so they trade money back and forth, but the Treasury relies on the Fed heavily to the tune of almost $1 trillion. The Fed also owes trillions of dollars to all kinds of other businesses globally, et cetera, et cetera. This gets complicated when you start adding in a snowball like we just went through in the midst of trillions of consumers' dollars with the Federal Reserve also. Bottom line. So let's cut to the chase and let's talk about exactly what we mean. The insolvency of the Federal Reserve is a massive deal. They are at this position now. Mathematically, there is no solution that's easy to this. So now the biggest question remains, now what? Okay, so let's say this is happening. It is. You saw the charts, you saw the graphs, you saw those overlaid together, you saw the before and after. What does this cause? What are the outcomes of this, right? We can't solve for outcomes until we identify them. There are a few likely outcomes of what we're looking at. The first is a reduction of the dollar, a reduction in the value of the dollar, okay? The reverse of that is inflation. Kind of two halves of the same coin, two heads of the same coin, okay? The reality is, and I've been shouting at the top of my lungs, I probably drive my team nuts at this point, but the biggest names in finance are agreeing on this, is that we are not out of the woods on inflation. While we might be saying and high-fiving and congratulating each other and patting each other on the back that inflation came in at 2.4, the CPI came back at 2.4 most recently. The reality is there are inflationary pressures that are 10 to 20 years out. This is one of them. This is a unresolved line item that is growing, okay? So that's a scary situation, is that this could be a massive inflationary pressure down the line. We'll go into some others that swirl around with this and affect the inflation trend in the US and what that could look like. The biggest worst case scenario, let's absolutely not beat around the bush. The worst case scenario is that we lose the US dollar's reserve currency status. Now, I will say without question, this is the worst case scenario, but the US dollar is backed up by two things. And these are two reasons why I don't think we're going to jump directly to this loss of reserve currency status. The US dollar is backed up, one, by just volume. There's so much, tens of trillions in circulation that other currencies can't even touch. I mean, who would step up? China? The Chinese renminbi, right? No chance. The CCP, Xi, they don't want that to be the reserve currency because they can't control it, right? It's a different model of government and they don't really have an interest when you drill down. What's next? The euro? Amazing. Eurozone's great, but I mean, we kind of back them up, right? We're kind of like their financial big brother, so not really the euro. The BRICS, I don't know. I mean, they can't really agree on anything. They kind of backstab constantly. There's just no other good option for a reserve currency in the world, okay? So I don't see that being the case, but the second that backs up the reserve currency status of the world is the full faith and power of the US military. Now, whether you agree with that or not, as far as morally, the reality is that's the case. The reality is we are head and shoulders above the rest of the world in military power any way you split that up. Okay. So in the case that a country was talking about truly going off the reserve currency status, I'm not talking about Saudi Arabia that flirts with us because they want more support in the region. I'm talking about a big middle finger to the US where they really truly are trying to stiff us on reserve currency status. I believe that's World War III very quickly. I literally think we would go to a world war to reserve or to maintain the reserve currency status. So I don't think that's the case, that we're going to lose reserve currency status for those two reasons, but that would be worst case scenario. And if we're not careful and we keep devaluing the dollar and increasing inflation on the dollar, it only pushes us closer to something catastrophic like loss of reserve currency status. So let's talk about inflation a little bit, because, you know, those two drivers, the reduction in value of the dollar and increase in inflation, they both are lumped in here. Money is always in motion. We know this. So understanding the larger economic picture of loss of value of money is important in this regard. So we have the ability and the benefit of working with some really amazing investors at Saint. We'll dive into some of their strategies that we're seeing some of the top individuals use. But let's go through a little bit of what the past and the future hold and what we've seen. Just a reminder, mid-2022, the peak was 9.1% on inflation. It has gotten better since then, but we saw that leak out and affect the economy dramatically. We are seeing the CEOs of major banks, the CEOs and the front runners, the spokespeople of major financial institutions come out vocally, and even in the last couple months, saying that we need to get a grip around inflation and the inflationary pressures. So let's say inflation's high. Let's say inflationary pressures are high. How do both things exist? How do we exist where the CPI is at 2.4%, which is what it is, and there are deep, wide inflationary pressures in the market? Well, we see that come out in things that offset inflation. Just a reminder, the Fed mandate for inflation is 2%. We're only at 2.4. And that's after the steepest rate hikes in history. We're still not at the Fed mandate of 2%. So there's a lot of reasons for that. But one of the major reasons we as consumers, or what are the major effects and things that we'll experience as consumers, we're probably going to see higher mortgage rates for 10, maybe even up to 20 years. So with rates being in discussion of, hey, you know, even the Fed dot plot, let's jump in. Let's throw this up in the background. Even the Fed dot plot is talking about reducing rates. You'll see here, previously June 12th, the Fed target was 5.25 to 5.5. That has dropped. We're at about 5% now for the Fed target. So they've been keeping their promise, right? The Fed's been keeping their promise. They've been saying this is what they see as, okay. So for those that don't know the Federal Reserve dot plot, the Federal Open Market Committee members put a dot of where they see the future of rates going. So this is a little bit of a look into the Fed's crystal ball of what they think rates are going to be going into the future. So what we see is that they did decrease by not 25 basis points, 50 basis points. And that over the next year to 2 years, they see a total of 2% in rates reduced at the federal funds target rate. Okay. So us as consumers, again, seeing a parallel, instead of 6.5% rates, we might see 4.5% rates by year end 2026. I don't know. I'm not so optimistic. I think the Fed has missed the mark a number of times. I would say if you look at where we're, looking at a few different things hitting at one time and coalescing in the marketplace, I think we're probably sitting at between 5 and 6% rates for an extended period of time. That's my personal bet on what I see for the future. But is that so bad? Because if you look at the last 100 years of mortgage rates in the US, that's pretty much the average. So while there are more inflationary pressures than we're used to, over the last 100 years, that does just kind of balance the books back to the norm. So here's where we're at with inflation right now. Here's some staggering statistics that might upset your stomach. So be ready. The first is, since 2020, we have printed over 80% of every US dollar in history. Pre-2020, so in the last 200 something years, we printed 20% of every dollar that's ever existed. And then after 2020, over 80% of every dollar that's ever existed. Okay. Before 2020, we had around 4 trillion in circulation. Now there's over 20 trillion US dollars in circulation globally. That's over a 375% jump in just several years. At the beginning of 2021, right, where we just started our money printing extravaganza, inflation was at 1.4%. Very mild. Within 17 months, 9.1%. Boom. Ouch. So while we can sit and say supply chain, I'm not saying that that wasn't part of it. It was, still is, right? We're shifting away from China. We're doing some nearshoring and manufacturing, et cetera, et cetera. Lots of changes still going on. But we also printed 80% of every dollar that's ever existed. And by the way, while we have a lot of respect for the Federal Reserve, they weren't exactly honest, or they were stupid. So they were either stealing from us and not being honest, or they were being stupid, right? Miss Yellen, who's brilliant. She did amazing things for this country. She did, she's a massive leader in finance for her terms. She could not stop yelling at the top of her lungs. Inflation is transitory. Who remembers this? If you remember this, drop in chat yes, okay? Because I was listening to this in the news being like, are you kidding me? You cannot print that degree of money and not have repercussions, okay? So she was wrong, clearly, because 17 months later, we were at 9%, over 9%. Inflation was not transitory, okay? Now, since then, where are we at today? Since then, we have experienced the largest rate increases in the shortest period of time in history. We said that. This is just a little outline of that, what that looks like. Much stickier and much more stubborn than we ever anticipated, especially the Federal Reserve. I believe that's why they've gotten more aggressive, because they realize that it's a much bigger problem. So what's been the impact of that? Inflation, we know it's bad, but why? Why is inflation bad? What does it mean for you as consumers, for you as investors, for you as people with families and friends and in the economy and living your life? We have lost 25. I think this number is much higher now. I got to double check on the most recent. We've lost over 25% of our buying power in the economy. So what used to be, X now costs 25% more, meaning dollars have lost 25% of their worth. The US dollar in that short period of time. Brutal. Now, unemployment. This is a weird one. Employment has been stable for so long. Well, it was until those numbers were amended by over 1 million jobs that they miscalculated. Ouch. Okay. We'll get back to that in a second. But unemployment was below 4% for 2 years. So in the midst of all this crisis and this craziness, and oh no, employment was still pretty steady. Home prices have increased over 45%. So if you're a homeowner, Hell yeah. Congratulations. That's big for you. Net worth bumped up a lot from that. But rates also went through the ceiling when rates went crazy. So the net impact of 45% increase in home prices plus the increase in rates, the net impact is mortgage payments have gone up over 111%. Now, not only that, there are inflationary mega trends globally, and we can't wait to jump into all kinds of fun ones on future webinars, but I don't want to go overly down the webinar or right down the rabbit hole here. There's huge inflationary trends with the wars, with everything from agriculture, et cetera, et cetera. So I talked about some big names in finance that have bets on a 10 plus year inflation outlook. Rick Rieder from BlackRock, Bill Ackman, Howard Marks. I mean, these are legends. John, I see you on here. You might know some of these names with your background, right? But anyways, these are big individuals in the financial sector, and they're betting on 10 plus years ahead. Now, you could argue maybe Bill Ackman is a contrarian, right? Maybe Howard Marks is overly pessimistic, et cetera. But these guys don't have, 100 billion plus under management. Rick Rieder's at BlackRock, okay? So that's their outlook with their fundamentals, and they've talked openly about this. So we've talked about this rise in cost, relatively resilient employment numbers, although those have been amended. So employment numbers should have spiked more, but they didn't. That's a good thing, right? Well, why didn't they spike? That might be the answer to if that's a good thing or if that's a bad thing. So let's talk now why actually why unemployment numbers not spiking might be a very bad thing. The baby boomer generation, our beloved baby boomers. The majority of our investors are often the baby boomer generation, okay? They are either slowly working on their way exiting the workforce or are fully retired. What's interesting about the boomer generation is it's the largest generation we've ever had in history, and it's also the most wealthy, okay? Those two stats shaped our country in a very big way. After the baby boomer was Gen X, a very unique generation with skills and tech skills and all kinds of things that we didn't really see in the boomers, but it's a much smaller generation. They had to deal with the freaking gigantic boomer generation for pretty much their whole careers, right? They still are. Below the Gen X generation are the millennials. So the giant baby boomer generation, the largest we had ever seen at that time, then had the boomer generation, then had the millennials, which is by far the biggest generation in the United States today, okay? Below the millennials is Gen Z. Gen X had Gen Z. So Gen X, a smaller generation by American standards, had Gen Z, which is the smallest generation that we've ever seen in modern America. That sets the tone of what this next piece is. When the baby boomers are exiting the workforce, which they are and which they have already exited, much more than half of baby boomers have exited the workforce. What's replacing the baby boomers in the workforce is Gen Z, which is the smallest generation we've ever had in U.S. modern history, and is the lowest participation rate by percentage. Boomers, big participators in the market. The percentage of boomers that were working is very high. Gen X, same. Millennials, it's slightly less, right? Maybe part-time baristas a little bit more than previous generations, right? But they've entered, now they're having families. Millennials are buying houses, et cetera. They're kind of stepping into that. Gen Z is the lowest labor participation we've ever seen by a wide margin, and it's the smallest generation. So when the biggest generation leaves the workforce and is replaced by the smallest generation, that has impacts on things like labor rates. That has impacts on things like labor inflation, if you want to think of it that way. So where we would have expected, if all generations were created equal in size, what we would have expected is as the boomers left and as Gen Z one-to-one replaced the boomers, we would have seen more unemployment spike. But because a big generation is being replaced by a small generation, the labor market has been much tighter. So we didn't see that expected spike in unemployment. Largest generation is leaving. Smallest generation is replacing them. Okay. So what does this all mean? Now, with the Gen Z generation stepping into the workplace, wages are going up a lot because it's a small generation. They're replacing a large generation. There's wage inflation in a big degree. Another upward trend on inflation. So, a little bit of a backdrop of what inflation looks like. Let's take a look at the US dollar in relation to what all this looks like. Understanding the US dollar has several drivers. So the facts aren't pretty with some of this, but the reality is that with these changes to the US dollar, the question is, what are you going to do about it on your end as investors? Okay, that's a big question. I'll take a moment to talk about what our top highest level investors came to us and told us they were looking for in the marketplace. So at Saint, we work very closely with a lot of sophisticated individuals. We have that major benefit. Frankly, it's kind of a shortcut for us to see what's going on in the most sophisticated parts of the market. Our highest investors, our highest level investors, the most strategic investors, we've done syndications. We did 19 syndications, 7 successful exits. We could brag about those numbers all day long, but there was a shift in the marketplace with all this going on. The most sophisticated and the most forward-thinking investors were coming to us and saying, hey, Nick, hey, Saint, what we really would like to see is a return that beats the bank, that crushes the bank, that's based on real estate still, that's real estate hard asset backed. Because if inflation goes crazy, or if the value of the US dollar goes down, we want real estate to be backing that investment. And 3, so it's 1, 2, and 3, that the return is fixed. They wanted fixed income. They weren't looking for a performance structure right now with all the craziness going on. So that's the genesis of the Saint Income Fund. We pay 12 to 14.28% per year. It's 100% real estate backed. If you want to set up a call, you have the number there. You can call us now if you want. We also have the QR code. Luke or Ange, there we go. Ange, you beat me to it. So the calendar link, you can set it up now. You can set up a call with Luke. He'll jump in. He'll listen to what you got to say about your portfolio and your needs, and he'll see how we overlap and if we could meet your needs and knock it out of the park for you, and if you're a good fit for our product. So that is what we're seeing with some of the highest level investors, the people we respect most in the Saint ecosphere. So we like to stay away from the P word of predictions, but let's talk about if we were to make predictions, in what vein they would look like, okay? Let's talk about the goods, the bads, the uglies, and most importantly, what we see as the biggest opportunities in the market. CDs and savings accounts. Okay, we've seen these spike, right? As rates have gone up, right? We talked about previously, as rates go up, you're disincentivized to take out loans because they're more expensive, but you're incentivized to keep your cash in the bank because you're getting a higher return for it, right? We're in a fixed income space at Saint. So we constantly have discussions with people. Oh, well, my bank's paying this, the CD's paying that, my savings account's paying this. Guys, we looked at the dot plot. We looked at the Federal Reserve dot plot. That comes from the Federal Reserve. That's them telling us what their game plan is for the next 2 years. They are planning on reducing their rates over the next 2 years by 2%. So if it's a 4 or 4.5% return that you're getting today, the Federal Reserve is yelling at the top of their lungs, they're putting it on everything, that you are going to, every time you sign up for another CD or month after month, quarter after quarter, that you have cash in a savings account, you are going to be reducing your return. So let's say 2 years from now, rates reduced by 2%, your returns reduced by 2%, and inflation's at 2%, you're at net zero. So the bad is that cash is dead. We're going to put a pin in that. Cash is dead. You got to be out ahead of it and find what the next opportunity is for you, because a net zero for us is not an option as investors for us. Savings accounts are dead. Brutal. But the reality is, if you look at those numbers, that is the case. Unless you're a net zero person. If you're okay with net zero, I don't want to, rain on your parade. But frankly, think about the risk in the market. I don't know. I'm just not that. I'm not that guy. I mean, the best outcome is break even. I don't know. Anyways, I could go on all day. So opportunity wise, what we're hearing from our highest level investors is they're looking at opportunities like fixed income. Why? Because there are private investment opportunities. We are one of them, but there are private investment opportunities that crush the market because the returns of income funds are not based on CDs or savings rates, right? They're based on underlying assets. If the investment criteria and investment thesis is based on something like mortgages or real estate, then that is separate. That's separate from what banks are doing specifically on their CDs and interest rates there. So this is a big opportunity. Mortgages, I mean, look, I'm so partial. I'm very open about that. I am absolutely see mortgages as the number one opportunity moving forward, particularly for single family, because it's such a rock solid asset class. The rest of the world doesn't have fixed rates for 10, 20, 30 years at a time, okay? The rest of the world has variable rates, adjustable rates in different formats, and certainly not 30 years at a time, okay? So it's such an opportunity, and I really like our model for that. So again, I'm very biased on that. Let's talk about if rates go up, which that's not the case today. We're seeing rates on the downswing, right? We're seeing the dot plot, but in the market with the conditions that we're seeing, let's see how that might affect. Let's do a thought experiment of how that might affect different asset classes in the market. Now, if rates go up and you own mortgages, we'll just start with mortgages. If you own mortgages, that means they're more stable. Because if you own mortgages at 5% rates, and then the market rate goes to 6 or 7 or 8, who the heck's going to refinance when they're at a 5 for the next 10 to 20 years, 30 years, right? Not going to have a lot of turnover in that portfolio. Real estate, I still love real estate. I think real estate is particularly industrial real estate, and that's going to be a whole separate webinar. I'm extremely partial to the future of US manufacturing, the future of US distribution. I think that's going to be nearshore in the southern US, near ports. I think that's going to be near distribution channels. I think even northern Mexico, but I digress. Real estate in general, as rates go up, I actually don't hate real estate. Many people shy away from it because sellers don't want to drop their pricing in line with the rate increases. So oftentimes it can cramp returns. I still don't hate that as long as you're a long-term buyer. Let me tell you why. There's an old joke that you date the rate, but you marry the property. You marry the asset, okay? So let's say you're only getting a slight discount on the property, but your rate's a little bit higher. You're still getting a discount, okay? How we buy hard assets, how we buy properties, it's 99% off market. So we're confident that we're buying at good rates. Even our mortgages, we buy off market. We're buying at good rates. So if you can buy off market when rates are high, you can refinance to a lower rate, but you can't ever make up the basis, the purchase price of an asset. So the cash flow is more stabilized on the long term because your entry point on the pricing is lower. Let me think about it. Yes, your entry point on the purchase price is lower, although your net cost is higher with the higher rate. If rates go down, it stimulates buying. The market heats up. So most people enter the real estate market when rates go down because what their thought process is, well, my mortgage is going to be cheaper. Maybe. I mean, we saw that home prices went up 45% in the last few years. So is your mortgage rate cheaper if the underlying asset goes up 45%? I don't know about that. Even if rates stay the same, the underlying asset increasing by 45% is much more expensive. So I'm a contrarian in that way. I like down markets for a lot of different reasons. I think there's big opportunities. I think there's a lot of opportunity in the market we're in today for that. So you might see some new opportunities come out from Saint soon, and you might see some really big opportunities happening in the income fund also. But for mortgages, let's say rates go down and you own a bunch of mortgages, let's say 500 plus in 21 plus states. What happens is if your average rate is say 5 or 6% and the market rate goes below that, you'll see people refinance. That's great. You get paid out early. So all your returns that you would have to wait 20, 30 years, that's condensed to right now. You get the cash up front. If you run the time value money equation on that, a TVM on that, it's such a big win. Most importantly, if you're buying the assets for good prices, different discussion of acquisitions. So it does boost returns because you're taking that money today. If rates go down, sure, it's still an opportunity to buy real estate, but really if you're a real estate owner and rates go down, your asset is going to go up in value, right? That's the statistics on that. So if you buy correctly and you own correctly, then in the future, when rates go down and decrease, your asset should go up in value in most market conditions. That's a big highlight. Okay, real quick, right before we hop into Q&A, again, I'm going to put this up. Typically, people want to book a couple calls typically there's a number of calls booked with Luke. I'll phrase it that way. That's better phrasing. So I want to make sure you have the opportunity to do so. The Saint Income Fund has over 500 mortgages in over 21 states. You just saw a huge deep dive into the topics that we're looking at. This is how we analyze the market. We're looking at it from 5 different angles. What's the Federal Reserve doing? What are they saying? What's the charting? What's the overlays? How these compare to each other? How do these compare to our asset classes? How do these compare specifically with performance in that? So we could drill down on that. We will. We have a really deep dive, a great deep dive coming in the next several months on some investment strategies we're looking at. But I highly encourage you to book a call with Luke. Throw frisbees at him, ask as many questions as you can to get comfortable with what we do, because it's a big opportunity. While interest rates are going down and while bank returns are going down, you have guys like Luke that have assets that are paying out 12 to 14% returns because the underlying assets of mortgages that are paying on time with 96.7% on-time payments in our portfolio are crushing it. So highly encourage you guys to get on the phone and have a personalized investment strategy call.